Welcome back to the Lobster Talks podcast. Today I have Laurie again. Hey, Laurie, thanks for being here. And we're going to talk about YC in 2025, about what's changing, what remains the same, the four batches, AI in 2025 with potentially AGI coming. So there's a lot to cover. Let's jump in. Laurie, thank you for being here today.
Yeah, it's good to be back. And we just come out of a great year for Lobster. So it might be good just to quickly reflect back on how 2024 went. Some great investments in some companies that are now producing some super impressive metrics. So just like it'd be great to hear just a comment on how last year was.
Yeah, absolutely. You're right. I'm talking already about 25. That's my mindset. I already, want to talk about the future, but 24, you're right, was an amazing year for Lobster. So I started Lobster in 2023, which was sort of the beginning, the initial fundraise, et cetera, et cetera. I was still fundraising in 24, and I'm very, very happy to say that Fund One is massively oversubscribed, way like over 50%. So that's, very, very exciting. And I've, of course, started deploying a little bit in 23, but again, 23 was the beginning. 24, I've really deployed in many, many more startups. And you're right. What's interesting is we already today, even though the fund is very young, less than 2 years old, we already today have some companies that are doing absolutely, absolutely amazing. I can, name a company I'm not going to name them, but I'm going to talk about a company we invested in September, and they're doing 2 million in ARR after something like a year of getting started, 0 to 2 million in a year, which is pretty impressive. That was September 24. But in December, this jumped to 3.7. So from 0 to 2 in 1 year, and then in 4 months, from 2 to 3.7. So that's, one example, but we have many, many companies that are on a very, very fast growing trajectory. One of our earliest investment, mid 23, is already preparing a very, very big Series A for Q1 25. So, in the coming weeks. So yeah, many, many companies of the portfolio are doing well, very excited. And of course, we're only getting started. 25 is going to bring more investments on Lobster Fund One. And of course, I'm also thinking about the future as well.
Yeah, we got a slight taste of what will look like with the extra YC batch in right at the end of I know we've covered it before, but maybe a little bit more from Lobster's perspective, from like operationally or from like a deploying capital perspective. Like what does that shift actually mean now that there's these kind of four batches?
Yeah, absolutely. So we've talked about it for those who still don't know. YC is moving to 4 batches a year, so every quarter. And so we had the first ever fall batch that also we covered. So you can listen or watch the previous episode if you're interested on the sort of the everything that Laurie and I thought about this batch. But what's interesting, what we've talked about is more batches with less companies allows a better match in between companies and in between investors, such as myself. So it's going to be easier for me. Instead of having twice a year a big number of startups, it's going to be 4 times a year smaller number. What's interesting as well is smaller batches probably means more attention to those startups from YC itself, from the group partners, et cetera, et cetera. And my job at Lobster is finding in every batch the top. I say the sort of the marketing, but it's not only marketing. I say I only invest in the top 2% of YC companies. So what I mean by that is in every batch, I will find, usually it would be a batch of 200. And so 2% is 4. I would find the maybe 4 to 8 startups that are growing the fastest, that have the most revenue. That's my number one metric. I look at other things as well, of course, and team, defensibility, etc. But the number one thing I'm looking for is early traction. And then out of those 4 to 8, I will usually get allocation to 80, 90% of them, and then select maybe 3, maybe 4, maybe 5. But those companies are rare. It's a very rare breed. If you look at YC in general, there's very few companies that have, over 500,000 in revenue. Remember, the startups are 3 to 9 month old. So it's very difficult to get 500,000 in such a short time. More batches, I think, I'm pretty sure there's always going to be a top 5 startups in every batch, but then there's going to be twice as many batches. So I think it's going to almost double the number of opportunities. And why do I think the number is going to remain the same? It's because of selection. There's companies, we've talked about it, I think, as well, or I've talked about it on a video on YouTube, where there would be companies growing very, very fast who would not wait for the next batch. If the next batch is in 6 months or in 4 or 5 months, depending on when you apply, maybe you don't have time to wait because you're growing too quickly. Now, with every quarter, you have a batch starting in a couple of weeks. You can just go into YC, and the extra attention that they're going to get from YC in general means that some of them can grow faster. So I think those exceptional companies that I'm looking for, there's going to probably be a little bit more of them. It also means that my schedule as an investor is much more regular. Twice a year, I would get very bored in between. By the way, of course, I would still invest in other companies from previous batches that I kept in relationship with that didn't have the traction at the time, but now they're finally growing. Now it's, just a never-ending cycle. So I'm much more excited. Probably it will allow Lobster Capital to deploy more money in YC. Fund one was relatively small in the world of funds, but of course I'm thinking already of fund two and even beyond, fund three, four, and five. And so it's always been a question: is there enough room to deploy a $500 million fund only in YC? And by the way, I'm not at 500 million by a long shot, but it is a question, what do I want to do? I love YC very much, but if I both want to have a 500 million fund and invest in YC, maybe it's not compatible. Now with, four cohorts, it actually makes Lobster an even more interesting fund to LPs. They're going to fund even more startups. So all of this was great news for YC, for the startups, and for Lobster. And I'm very excited to see finally 4 batches in the same year in 25.
Yeah, there's something you touched on there. Well, two things. One is around how, you know, how does a bigger fund translate into wise? But a little bit before that, you mentioned how your focus is primarily on looking for the companies where, revenue seems to be growing quickly, or there's traction in there. Now, what we saw from the last batch in the full batch in December, there was like one of the batches with the fastest growing revenue, the quickest time to kind of big revenue metrics. I think is one of the top performing batches ever in YC in terms of revenue. And there's a lot of factors that go into that, partly things like TikTok allowing distribution of consumer apps to happen a lot quicker. People have kind of figured out marketing channels now and all that sort of stuff. But then obviously AI plays a big part in the speed of development as well. But with companies now reaching, I guess, meaningful revenue faster, when you're presented with a batch that maybe the 6th, 7th company has revenue that matches or some of the top companies from previous years, how do you quantify or evaluate what meaningful revenue actually is?
Yeah. I mean, so first of all, the question is amazing. I'm excited to dive into it, but we should double click. Like, so many people have criticized YC saying, the companies don't have revenue. It's a big factory. It's only about the numbers, but the quality is not good, etc. Fall 24 batch, like you just said, had the biggest growth numbers of ever in any YC batch since 2005. So, that's already something. And like you said, there's a lot of factors. In 2005, you didn't have TikTok, you didn't have AI. They're building much faster with AI today. So, but just the quality of YC is very much arguably going higher, not going lower. And again, having 4 batches means you're not missing out on companies that are growing very, very fast and who wouldn't have the time to wait, like I just mentioned. Now, it might be it's a very good problem to have, right? I have too many companies with great revenue to choose from. First of all, achieving such revenue, and I'm talking about over $500,000 in revenue or recurring revenue in a few months, still is extremely hard. We being in YC myself, being with the YC world every day, you start thinking that, success is so easy. You build something and poof, you're $1 billion company and you get an exit. It's very, very, very hard. It's very, very difficult to do all that and to build a company. And so even in YC, success and $1 billion valuation is not the norm. It's still the exception because it's extremely, extremely, extremely difficult. Okay. But that being said, more companies reaching that is great news. I don't think it's going to be 100% of the batch. I still think it's going to be the top, if I select the top 2%, maybe it's the top 4, 5, 6, maybe 10%. But I have other criteria there It's not only about traction. I'm interested in companies that, so for example, there's a lot of AI companies in YC. I'm interested in companies that have a very good long-term potential. There's a lot of dev tools that are very useful today or today's problem with AI, but because we don't know what AI is going to be like in 5 years from now, maybe we have AGI, maybe we get to talk about that as well. We don't know if those tools are even useful anymore. And so I'm being very careful when I invest in AI about that, about longevity and about the use in the ever changing world of AI. That's why when AI first came out, November 22, we get ChatGPT. Then in, I believe, May 23, so 6 months later, I wrote a piece on LinkedIn that said why I'm not investing in AI. I thought at the time it was too early and I was being very careful. I, of course, then been very public about changing my mind and thinking that the market had matured enough that I could now invest in AI. But still, I remember those first worries that I had, that at the time we were saying, what if ChatGPT has a new version and you're just a GPT wrapper and your company disappears? And that was a problem at the time. Today, startups have figured out that this is a risk. So they're building on top, and that's not really a risk anymore. But there's this risk that I just mentioned. We don't even know what AI and the world are going to be like in 5 years. So that's another criteria. And then there's the criteria of the team. I want the team to be such and such and such. I've met, tens of thousands of entrepreneurs in my life now. And so I it's human relationship, but still there's a lot of things that I feel that I qualify and that I'm looking for that I find or don't find. And then I'm looking at defensibility. I think I posted about this on LinkedIn, where revenue might be faster. Sometimes go to market might be faster. It's true for you. It's also going to be true for your competitors. And so how do you defend against that? There's no single answer. A very good one is customer relationship. What do you build, in terms of trust, in terms of brand with your customers? Because today with AI, you could build an Airbnb replica in half a day, but Airbnb is the brand and people know and trust this brand. So, which is a YC startup, obviously. So yes, more companies reaching great valuations faster, amazing news. It is the thing that I talk about the most because still it is the exception, including at YC, that companies have so much revenue in such a short time. But it absolutely is not the only thing that I am, looking for. And so there's a lot of other criteria for me to still evaluate, to still filter. And I was talking with one of my investors, and I said, well, in the latest batch, I did only. It's not this batch; it was the batch before. I did only maybe 2 investments out of. It was a bigger batch out of 200, 2 out of 200, and I said, I was potentially looking for more. I would have wished to have invested maybe in a third, in a fourth company. But like I said to him, I never compromise on quality. It always has to be, past a certain bar and a very high standard. And I was very surprised that he answered to me. He said, I actually think I'm glad you didn't invest in more. I'm an LP in your fund, so you're a filter. I wouldn't want you to invest into too many. I want you to be very, very selective. And he's absolutely right. I was like, nothing to add there. So I'm not in a volume business. Many people do volume in YC and try to index. It's a very long answer. I'll stop there. But I mean, in the very, picking very, very few, but hopefully very well.
Yeah. And 2 questions then in there around that kind of speed to revenue. And at the same time, this kind of looming threat of big companies like Google and ChatGPT, sorry, OpenAI, and, even Facebook now with their continuous updates to their AI tools. The first one is around if companies are able to get to market quicker, build quicker, and reach revenue quicker, they're less likely to be going on the more traditional cycle of venture where you raise a little bit of money to build, then you raise a little bit more to go to market, you raise to scale, you raise to scale again, and so forth. Because they could be building very quickly with a very low budget, getting to profitability, and then raising maybe once or coming out of YC, just taking that first round. And then they might reach that kind of, 3 million, 5 million, even 10 million and just chill. But that doesn't necessarily support the model of venture funds, especially bigger venture funds. And so maybe just talk about that in terms of like when you're looking at those companies, how do you evaluate them from a venture returns perspective, both from venture as a whole, where funds can be in excess of $250 million funds, and then Lobster more specifically, which is obviously on the smaller side of VC funds.
You're absolutely right. 2025 might be the first year we have a unicorn with less than 10 employees, maybe a unicorn with no employees, just a team of like two, three, four co-founders, and boom, they become a unicorn. It might be a very inflated valuation unicorn, like probably they don't have 100 million of revenue, but you could make tens of millions of revenue with just a founding team. The startup that I invested into that I mentioned that jumped from 2 to 4 million of ARR. So they're a little bit over a year old, and I think they're hiring their first engineer right now. Today, it's just two co-founders, and they're making 4 million in ARR. It's insane. And so we know that AI sort of reshuffles the deck. There's a very strong chance that you need to raise much less. We've talked as well. I think you and I have talked about it, and I've posted on LinkedIn about Zapier, who just raised a seed, famously after YC and never raised again. And today they're doing over 100 million in ARR. There's also a company that I'm an investor in called Baobab from YC. They raised a seed after YC, 3 million or 3.5. And today they're doing over 100 million in revenue, and they haven't raised again. And so two conclusions. One, there's no dilution. It's actually amazing for seed investors. If you invest in Zapier at the seed, today it's a 100 million ARR business. If and when you have an exit, it's going to be at a very, very, very high valuation, and you have zero dilution. You haven't gotten anyone else to come and dilute you. Now, of course, funds, they want to get their pro rata. They want to put more money in the deal as well. This you can't do, but it might be compensated by, if you're in a seed and Zapier is probably worth several billions, it is a great exit anyway. So of course you wished you would have put more money, but this is sort of compensated by the no dilution that you have. The other thing that's, for me, it's amazing is it's very possible that pre-seed and seed investing becomes the only startup investing that there is. Or not the only, like Series A and above are not going to disappear, but like you alluded to, like you said, it's possible that volume falls 75%, 90%, because companies that just don't need that money anymore. And if that's the case, I'm in amazing shoes right now because I've done seed my whole life, and that's what I love, and that's what I want to keep doing. Now, it does beg the question, how do you deploy a $1 billion fund in seed? It's virtually impossible. And well, at least it's not what people do today. I think it's actually possible. I think, when you have a $1 billion fund, you're making a gazillion amount of money in management fees. And so you can hire a team of a lot of investors who are going to just write it's 1,000 checks, right? A billion is 1,000 checks of 1 million. Sorry, it's 1,000 times 1 million. So, if you deploy over 4 years, that's 250 checks per year. That's 5 per week. And so you probably need a team so that's 20 per month. Yeah, you need a team of 20 investors to each do one deal a month, and so hiring 20 people when you have a $1 billion fund is very possible. But we could have in the coming years, $1 billion funds that only do seed. Today, that doesn't exist. If you have a $1 billion fund, you do seed, but then you put more money afterward. Now, all of this being said, I actually don't think that Series A, B, C, and Ds are going to disappear. It's possible that the volume goes down, but there's still going to be companies who still want to raise, who still want to accelerate. AI is really helping you build faster today. But if you want to do, big global marketing, we're talking about Airbnb. Airbnb is advertising on TV, is advertising, in every big metropolis in every big city in the world, in the metro, on bus stops. It's you go to New York, London, Paris. There's Airbnb everywhere. That costs a lot of money, and today I think they're profitable. But when you're a series, equivalent to Series B, C, D company, you might want to still raise for marketing, for example, or for hiring or for something else. So I don't think it's going to disappear. It might change, but the best returns already are in seed today. It's famously renowned, but it might be even more so true in the future because of what we just talked about. And so, I'm very excited about that. I'm doing seed, perfect spot to be in. And Chamath Palihapitiya from the All In podcast actually called this probably a year ago already. In one of the pod, he said, seed investing is going to be the only investing that matters with AI. And so he already called it last year. And, I think we're starting to see it play out already now.
Yeah. And the other side of kind of people thinking around, venture returns is obviously as the big tech companies get even bigger, take more land, startups are increasingly having to verticalize, and we see this especially in the increasing amount of AI startups. Like some of the startups that are doing very well traction wise are those that are applying AI or large language models, other technology to incredibly specific niches. And they're really doing very well and owning those niches and getting to these, very impressive revenue points very quickly. But there isn't necessarily much space for them to move horizontally. And so they either get kind of stuck there where they hit a ceiling quite quickly within a market. Let's say you're in, even quite a big industry like the legal space or something like that. The ceiling isn't infinite, but you still need to grow to get to these returns because you need these really big revenue numbers, or you don't, and you get acquired earlier in your progress on revenue. And both of those scenarios obviously diminish the potential returns for investors. How do you kind of think about that? Because when you look at a batch like, YC, where all of these startups are now kind of increasingly really going for, small niches to kind of get this traction. How do you think about that from a venture returns perspective?
Yeah, I mean, we're really, hitting the nail on the head here. I think you're absolutely right with this analysis. So I think you're alluding to, or you're referring to Case Text, which is a YC company in the legal space that was acquired for 650 million. So first of all, I want to mention, yes, their growth is not infinite, but a 650 million acquisition probably does quite well for the VCs that, were in there. It's not a sort of moonshot, like a returning the fund 100x, which does happen. It's not $100 billion exit. It's not a Facebook or an Uber, but still, I think this fund is pretty interesting. Those funds are pretty happy to have that exit. But now you're absolutely right. Remember when I was saying there was this idea at the beginning, what if ChatGPT, releases a new version, a new model and kills your startup because you're just a GP wrapper? And so one of the answers was to get really, really verticalized, because you refine your model. Fine tuning is what I was looking for. Okay, you do a lot of fine tuning and refine your model. And with a lot of training data, then, ChatGPT is never going to become as good as Case Text, for example, in law, because ChatGPT wants to remain a generalist, and you're going vertically, and you're going to get better on that specific use case. So that was one of the answers. And you're also correct that there's a lot of those companies in YC, and you're also correct that, that market is actually sometimes not as big as you think. So that's one of the things that I'm very careful about when I'm investing. I was telling you about, one of the risks being, if you're a dev tool, we don't know what AI is going to be in 5 years. Another risk is the one you just said. If you're doing verticalized AI for garages, I've seen that in YC. It's not a bad idea, but how big is the garage market? And then if you want to go out of the garage market, can you? We don't know. We're not sure. So that is a problem. Remember, it's so two things. First, again, you can have still a like 650 million exit in the garage space. And again, that's not too bad for a fund. But venture is, it's a game where you only need one big winner to return your entire fund. So I'm not betting that those would be the biggest winners of their batch. That's why I'm not investing in them. But, they might prove us wrong. They might actually be able to go into different verticals, or they might just say, we'll just add another vertical and another, and we'll be a super vertical product, but in 10 niches. And now finally the market is big. Or they might actually expand horizontally one way or another. We don't know. It is not the type of bets that I've made so far. So I completely agree with this analysis, but I wouldn't say it's necessarily a bad bet. Again, it depends, what's the vision of the founding team, where they want to go. And some of those markets might be bigger than we think. I remember a YC company using AI to go into the insurance claims business, but they had a commission-based revenue model. And so, there's a lot of money in insurances, and there's a lot of commission to be made. And so, yes, maybe you're not going to have a $150 billion company like ChatGPT, but still, it could be much bigger than many other verticals. So again, I think it's a sort of a of a case by case point here that you have to make. But I do agree that those were, and so we might be thinking, why is YC, taking so many of those companies? I think still AI is disrupting those industries so quickly. And when the group partners at YC, I know they talk about it very often on online, and I've talked about it with them as well. They It's also an opportunity cost. You can either take the next, every batch you have to select what are the best companies that you think are going to make the most money. And you can take the next company that's trying to be the next, Gen AI image generation, like it's been done already 10,000 times. Or you can take someone that's really trying to disrupt the garage or auto shop industry with AI that no one else is doing, has literally zero competitors because it's not very sexy niche, but he's actually growing so quickly. And even if it's not a 100 billion exit, but just a $1 billion exit, I think it's good for a lot of people, again, including funds that invest in those companies. So I think that's why YC is doing it. I don't think they're wrong. I haven't made many bets like that, like I've said, or I've made actually some of them in the video space, because I think video is, it is a market that's so big, and ChatGPT is really, really far, even though now they have Sora. But I haven't invested in Sora competitors. I don't want to get into details here. But anyway, I think this is a super big enough market that it can sustain its own unicorns and decacorns, etc. And so that's again the kind of question you got to ask yourself: is it Photoshop or is it video? That's the kind of thing you gotta refine in your decision.
Yeah, and so you mentioned K-Steaks, who obviously sold for 650 million, which is a huge return, especially for very seed focused funds or who are typically smaller, like yourselves. That would be like obviously a super exit. But just kind of want to think there around this like verticalization and where does source of liquidity come from. So obviously with YC is something like 17 companies have gone public. I think 101 unicorns. Is it just now that the expectations in the exit market from a VC perspective and even from an LP perspective has changed, just because actually to get to the scale you need to go public just doesn't really happen as much because these companies like Adobe or Google or Facebook, etc., are so much bigger. Like even Figma is a very good example. Like they get to that scale, but they don't go public. They look to get acquired by Adobe, or K-Stake's another good example. They could be pushing to go to these IPO liquidities where you start getting the 1,000x returns, but instead they don't. They exit to a larger company that's already been public. So is there room for these companies to go and get those 1,000x's, or is it just this shift in expectations from LPs and VCs around, oh, okay, well, actually, for us, we're looking for those ones that can get to that level of profitability, and then maybe they're having a 10x on a 50 mil run rate or something.
It's a very good question. I mean, I do want to mention that, also the 1,000x or 10,000x or more that you see in the stock market is usually when you hold the stock after the IPO, right? If you sold Amazon when it IPO'd, or if you kept it, you would actually, I think you would have made more money after Amazon went public than before, because it went public very early. It is true that companies have delayed and delayed and delayed going public. It's taking, longer and longer time. And you're in a position today that's pretty exceptional, where you have a lot of very, very big public tech companies that have a lot of money, including buying with their public stock to buy those startups. You mentioned Adobe, but Microsoft, Facebook, Apple are all doing it as well. So that's, one thing to take into consideration is when you're a fund, usually you will sell at the IPO, not hold it for the next 20 years. So you usually don't share into those huge, huge, huge returns that come after. It depends, but that's just, as a preamble. Now, so if you ask the expectation of the LPs, I want to say the expectation of the LPs never changed. They want as much money as possible, as quickly as possible. You also mentioned the expectation of VCs. I think VCs are more patient because they know it does take time, but they still want most money as possible. So I don't think VCs expect, oh, that's okay, I'll make a smaller return. That would be probably a bad VC, but I don't think such VC exists. Everyone the highest and biggest return. Your question also comes at a point in time where IPO window has been closed and IPOs have been very, very scarce, but there's a good chance that IPO window opens in 25 and after, and we might have a lot of catch up to do, and we might have a lot of IPOs. Remember in 21, 22, we would have, up to 10 companies going public every week. It would be like a lot. And so, yes, recently it's been longer and longer until you've went public, but those things change, those things evolve. It might actually come back that, oh, I might sell at 650, but I could just go public at 650 million valuation as well. It is possible to go public below $1 billion. You have to take into consideration as well that going public, you know, you have a lot of headaches. It costs money. It's several millions a year just to be public. And then everything you do, everything you say has to be scrutinized. You cannot say everything you want publicly, but also if you say the wrong thing, the stock goes down. Like it has a lot of positive externalities, but it also has some negative externalities to it. So it might be easier to just join a big name and you're paid in Adobe stock or Microsoft stock or whatever. That being said, I, I don't, you personally asked that question, but I've been in the room so many times when people have asked the question to YC founders, what's your exit strategy? What do you want to do? Do you want to sell? Do you want to IPO? And YC is this sort of unique place where people are extremely ambitious. Many people say, rightfully so or not, but once you've made it into YC, you've already made it. I think I can comment that I think it's very wrong because many YC companies still fail. Again, that's part of it. But anyway, people are extremely ambitious. And so I think I'm lucky that those founders are, I believe, more likely to, take it all the way to the IPO than if you just take random founders outside, in the US. So that's, one way to answer you. But if you talked about Figma and Adobe, I think it was what, a $3 billion deal or several billions, maybe it's 8, I don't remember, but it was very, very big outcome. Even if it's not in the stock market, it's still an incredible exit for the VCs. So, there's good exits there as
Yeah,
well.
I think
Sure.
it was 20 billion for Figma. Yeah.
Even, proves my point.
Yeah.
Exactly.
So I think like a lot of my questioning in a way has been sort of pushing you to imply that venture is changing. But actually, I think what's quite consistent is actually expectations of LPs aren't changing, expectations of VCs aren't changing, and expectations of founders aren't changing. Everybody still wants to get these $1 billion outcomes. But perhaps one thing that is changing from a quantitative point of view is the holding periods and returns to LPs. And so I think especially as a seed fund and, a seed fund investing in YC specifically, be interested to hear your opinions on that. Because I think what might increasingly happen over the next few years is these kind of alternative perhaps sources of liquidity. Say, for example, in secondary sales, as a company might have waited a really long time because their seed fund has gone a really long way. Now they're going to raise a really big Series A to do like the global domination. Maybe that's a good time for a smaller fund to try and create some liquidity. Or the other scenario where, some of the companies that you've invested in now, they're incredibly quickly are getting to these 5, 10, 15 million run rates. Well, what happens if they just wait and now they start distributing profits? Like, are these things that you're thinking about? Like what, maybe there's
Yes,
changes there. Yeah.
I am.
What are your thoughts on that?
I actually have a contrarian opinion there. I think everything is going to go back to accelerating. So the time to liquidity for funds has been notoriously slowing down. Everyone knows that, you if you go 20, 30 years back, you could get money back in 6, 7 years. Funds used to be 8 years. Now they're 10, but now they're even 10 plus 2. So they say, oh, it's 10, but actually it's 12. So it's been slowing down and slowing down and slowing down in the last, 10, 15 years. I don't, it's not because it has been slowing down for so long that it's not going to change. I think it's going to accelerate because people are very much fed up with this. Everyone, no one really likes that, especially investors and P's and funds. It's already 10-year fund is long, but if it's a 20-year fund, no one's going to invest anymore. That's a big problem. So the incentives are sort of backward. By the way, you're absolutely right. That's why in the last, 5 years, we've had a lot of secondary liquidity happen because it's just too long. And so it creates this sort of parallel secondary market, that's its name, to sort of counteract the slowing down. I personally believe we're at the peak. We're at the slowest that it's going to be. And I think now we're going back from the peak and it's going to accelerate again just because everyone again is fed up with that. Remember, we've talked about how AI accelerates everything accelerates startup building and go to market and making more money. So we've had two things. We had no AI, but also a very slow cycle in 23 and 24. I call them lost years because there's no IPOs and almost no liquidity and exit during those 2 years. But now 25, everyone says M&A and exits is going to pick up. IPO window is going to open as well. I already have a company that I'm investor in that has confidentially filed, so I know they're planning for an IPO in a couple months. So it is happening. IPO is going to open, M&A is going to open, and at the same time, you have companies being built faster thanks to AI and TikTok and everything we've talked about. So I really do think that this sort of era of things slowing down is is at its peak. I'm not saying it's coming to an end, but I think at its peak. And I think now we're gonna have exits faster. Because again, like you said, it's true, incentives or expectations haven't really changed. People want to have the best outcome. LPs, funds, and founders. Being a founder is so difficult. You don't do it for like you don't I was gonna say don't do it for the fun of it. Maybe you do, but still you expect a big outcome. So incentives are there, and the sooner the better. If you can get $1 billion exit in 6 or 8 years instead of 14, everybody wins. So yeah, that's my contrarian thought. Well, it's maybe not so contrarian, but anyway, you're right. Everyone is complaining about the time it gets. I do think it's gonna accelerate. I hope it does. If it doesn't, to answer maybe your initial question, yes, we have secondary that's not really quite well established. So it's always a possibility. But for sure, M&A and IPOs are going to come back at least that, much more and many of them than 23 and 4. So those are the possibilities. And it's good that if you're stuck, you have the secondary. And also, I want to add, if company distributes dividends or profits and you're holding a safe because it is the YC standard, you're not entitled to that. But companies, unless they're very acting in very bad faith, but otherwise companies will convert your safe into stock before having a distribution. Otherwise, they just literally slapping you in the face and messing with you, and you're going to complain and you're going to move, you're going to talk bad about them, etc., talk badly about them. So I've talked about it actually with the founder, and I said to him, he wants to distribute dividends. And I say, oh, are you going to and he says, yes, of course. If I distribute dividends, I convert everyone. That's the right thing to do. They don't have to on paper, but it's like, code of honor. I don't think there would be many. I don't think most companies would attempt sort of screwing their investors that way. Yeah.
Yeah, I think as well, like what you said is potentially quite contrarian because everyone's sort of worried about VC and this AI era, but actually, you know, to the extent that entrepreneurs need less capital because of AI, they're probably more leveraged. So returns on investing in them is higher because if leverage increases, it's going to increase for everyone. I think there's an evolve tweet, something along those lines. Yeah, just super quick before we go, it'd be good to hear about like your perspective again as a European looking into the American market, looking into the Silicon Valley market specifically. There's a lot of rumblings at the moment in European venture about trying to go more independent, trying to be more established, especially in the macro environment when the US seems to be increasingly looking inward. What's your kind of thoughts on that? Like, are there more European startups that are going to try and go to YC, or are they going to try and double down on Europe or LP sentiment in Europe as well?
I don't follow Europe, the startup scene at all, because haven't been investing in Europe for more than 5 years now. But as people can probably hear and people know about me, I'm French, and the economical and political situation in France right now, again, I don't follow closely, but is disastrous. It's terrible. And it's interesting. I've heard several Europeans, most of them French, I believe, but I don't know, Europeans who told me, wow, I've been to the US recently. I hadn't been for several years, and the price difference is now insane. And it's true. You can get a nice restaurant and a nice meal in Paris for 20 euros, which is now $21. In San Francisco or New York, with $21, you buy a cup of coffee, basically. Every lunch is going to be $100. And so for, those people, I don't even remember who they are specifically, but I remember the thought, like they go to the US and they're like, wow, I can really see us lagging behind and the US getting ahead and ahead and ahead just on the price of food. And if you look at growth, I think France projects zero point 0.5 in 2025. US projects between 2 and 3. There's several people who think that thanks to Doge, thanks to deregulation from Trump, we might have a 4 to 5% growth in the US in the next few years. That's just projections. It might not be true at all. But I also, I strongly believe that is one possibility. I have no idea if it's going to happen. But for sure, the US, the US economy and the European economy, just in general, already, not even talking about startups, just in general, are really splitting up, and it's not good for Europe. They're lagging behind. It sort of validates, like, I've made that decision to stop investing in Europe and invest here in the US already in 2019 or in 2020, so 5 years ago. So it validates my point. Then in the startup world, when the overall economy of the country is not good, or of the continent is not good, it doesn't help. But then, the European ecosystem still has the same problem as before. Nothing has changed. And I've talked about it extensively. You don't have exits because you don't have neither big companies to acquire like the Adobes and Microsoft we talked about. And you also don't have an IPO market. You don't have late stage VCs. So companies have a very tough time raising, over 10 or 20 million, or they have to go to American or Asian VCs. But, for a while, American VCs were very happy to play in Europe. Now, I don't think they want to touch Europe with a stick because it's so, Europe is in a bad position. I was going to say I'm from there, but I don't really sort of care anymore. Europe is in a very bad position, and European startups as well. And honestly, like, they already were in a not ideal situation last year, but because Europe in general is sort of slowly sinking, the startups, it doesn't do any good to them. Now, there's some good things for Europe. Trump is going to impose that European countries spend whatever percent on NATO on defense. They're mostly going to buy from American companies, buy weapons and stuff. So this is good for the US, but it's good for Europe. France is notoriously pretty good with producing weapons and stuff like that. We have some very strong companies. So that might be good for French economy. Again, it's not the startup world. It's not going to do much for the startup world. And again, it's those what's interesting is look at Anduril. Look at all of those drone companies started in YC that actually are on the field in Ukraine helping Ukrainians fight. Again, it's big companies, but it's also small startups that grow very quickly and become giants, like Anduril. Anduril was just a startup just a few years ago, and now it's a giant. That's not Europe. That's not France. France, we have those 3, 4, 5 big weapons companies, but how many weapons startups do we have? None. Again, a difference in the mentality of the ecosystem. So it's sort of like everybody's realizing now that investing in European startups is not that good and investing in the US is better. For me, I don't think much has really changed. It's just I've had that insight for 5 years. And for some reason, chauvinism, probably people, loving their country too much. People didn't want to admit, the French or the Brits or the Germans or whatever, they're like, no. Germany, Berlin is so good. London is so good. Paris is so good as a startup ecosystem. People just didn't want to admit. Still, love my country. I'm very happy and proud to be French. But I, in 2020, said, you know what, guys, that's not for me. And so I feel people are just realizing now because the proof might be even stronger. But I think, not so much has changed, but it actually has always been the case, or at least for the last 5 to 10 years, if that makes sense. That's my view anyway.
Yeah, perfect. And so just maybe last 30 seconds, is that what LPs on the ground in Europe are thinking? They're very increasingly US focused.
Yeah. It is insane how many. So it's very, very good for me. I mean, now I'm mostly, I think I started with mostly European LPs, and then in 24 shifted towards the US in general, because this is where I am. My content is in English and my investments are there. So more and more I'm talking with Americans. And by the way, Americans means nothing. The Americans are, Europeans and Asians, and people come from everywhere to the US. But yes, I've seen a shift in 24 with Europeans. I still have European LPs, and I'll still, welcome them if people our Europeans want to come talk to me. Happy to have that talk. But it's absolutely true that more and more Europeans are realizing that, and so they want access to the US, and it puts me in an interesting position, because they could go to an American fund run by an American, and and many do, that's not a problem. But even if we don't share, I don't speak German or Spanish, I speak French and English. Even Germans or, Portuguese, or I have people from Luxembourg, from Switzerland, they like coming to me. I've noticed, because we share that European origin. For some reason, like, I don't know if it's they trust me more because we're from the same continent. It brings us closer. Just like when you're abroad and you meet someone that's from your country, you're like, oh, you're French, oh, you're Brit, you're American, etc. So it creates a bond instantly, and it works for me on a European level. I see, oh, I could go to a US fund with a US manager, but I'm going to go to a US fund, which is Lobster Capital, but with a European manager, and I do spend some, I do come to Europe as well, and spend some time here. So this really works in my favor. So yes, to answer your question, LPs are really realizing, a few years ago, I would have had to say, hey, US is actually more interesting than Europe to invest in startups. And people would be like, I'm not sure, maybe I disagree or something. Now there's like no doubt. Oh yeah, it's in the US that it's happening. We need to be there. It's also in the US that AI is happening. Everybody knows AI is transformative. What's happening in AI in Europe? Almost, I mean, we have Mistral, which is again French, very happy, proud, etc. But apart from them, there's nothing happening. Which is, I'm laughing. I shouldn't. It's horrible, but that's the reality anyway. So people realize that, and yes, LPs do now want to invest in the US very, very heavily. That's it for today. I do have to run. I know you do know that, Laurie. So we're wrapping up. Thank you so much for you, Laurie, for all of your amazing questions and talking points. They were amazing. And thanks for you for listening through. Don't forget to subscribe on YouTube and or on your favorite podcast app, and leave us a 5-star review on Spotify or Apple Podcasts. This really, really helps. I will see you very soon on a next episode. And until then, you'll have a lot more content on YouTube, interviews with YC founders, videos about the world in 25, AGI, etc. So make sure to subscribe. Bye, everyone. And bye, Laurie. Thanks again.